Hello everybody, here's the French Bull speaking. Welcome to this new exciting learning series about Elliott wave. For chapter 1, we'll go over the basics, and for today's first lesson, we'll go over the classic structure for an Elliott wave cycle, the rules, some guidelines, and the personality of each wave. So, let's start with the beginning. Elliott wave theory, it's a system that helps you predict future price movement. So the goal is to find price targets and potential reversal. What we look for in Elliott wave is a structure of 5 waves. A 5-wave structure is what we call an impulse. In each impulse, we should be able to read what we call lesser degree waves. So, in the impulse, we got sub-impulsive move for the move that go along the trend, and what we call corrective move for the moves that go against the trend or sideways. So at the end, you got something like this. Impulse, corrective, impulse, corrective, impulse, which make you an impulse. Now, to keep things as clear as possible, we use different degrees of waves to identify which are inside of which. So here you can see, so we call the cycle or the ground cycle, super cycle, cycle, primary, intermediate, and minor. That the order from the largest to the smaller, to the smallest. Now there is more than just 6 degrees in Elliott wave. As you can see in trading view, go from super millennium to minuscule. Now it doesn't really matter which degree you use. The most important is to use smaller degree into a higher one. Now, let's talk about the basics rules. Wave 2 can't retrace beyond the origin of wave 1. Here's wave 1, wave 2 can't go beyond the origin of wave 1. Otherwise, this is not a trend anymore. It can be obvious, but that's a crucial rule. Wave 3 can't be the smallest of 1, 3, and 5. This is really important. The third wave can't be the smallest impulse into a 5-wave cycle. It can be smaller than 1 and wave 5. It can be smaller than one of them, but not both of them at the same time. So if wave 3 is smaller than wave 1, it means that wave 5 will be smaller than wave 3. And if wave 5 is longer than wave 3, it means that wave 1 will be smaller than wave 3. Okay? Now, wave 4 can't retrace beyond the origin of wave 3. Of course, like for wave 2, if wave 3 were to come below this point, it's not a trend anymore. We are not in an impulse. There is another rule for wave 4. It can seem redundant here, because so wave 4 don't go below the top of wave 1. Why is it two rules that seem redundant? It's because there's a specific kind of impulsive move where wave 4 can go below the top of 1, but we will see that in further lessons. For classic impulsive move, wave 4 should not go below the top of wave 1. Wave 2 can be a triangle, so same. We will go in further lessons in different kind of corrective movement. There is one that we call a triangle. Wave 2 can't be a triangle. Structure is what we call 5-3-5-3-5, because first is impulsive in 5 waves, and corrective, we call this 3. In specific corrective move, there is more than 3 moves, but we note this as a 3-way move. Now, for the guidelines, there is things that help you identify which count is the most likely. Usually, the wave 3 is the strongest in terms of volume, interest, and so in price movement and volume, and spread and volume. Wave 4 retraces in the area of lesser degree wave 4. As you see here, your wave 4 is in the area of this wave 4, more or less. Length of wave 5 equals length of wave 1. That's a classic structure. Wave 1 and 5 have the same length. And top of wave 5 from the divergence with wave 3 in terms of volume, which means we will get lesser volume during the wave 5. And we got divergence usually on oscillator like RSI. Now let's look at the classic one. Classic example in Bitcoin. Calculate this. Okay, and we show the volume. So here's the price action from Bitcoin in December 2018 to summer 2019. That we know now it's an impulsive wave. There's no doubt about this. So I'm going to take this part to show you. What we are looking at. So we got here first wave. I pull back for the 2. Here we got a wave 3. Sideways movement for the wave 4, and a final 5th. So let's put this as a cycle. So I'm not going to count the sub count for the first wave here. It's too small, but we can count for the wave 3. We got a wave 2, a wave 3, a wave 4, and a wave 5. And the same here, 1, 2, 3, 4, and 5. So you can already see that there is some guidelines that are not respected, because between wave 3 here, that we can put in red for example, is lower than what we see for wave 5. And the wave 5, if we don't put in a log, seem quite large compared to wave 3. But that's also why I wanted to show you this case. There is guidelines, but guidelines are not rules. They are very useful to find what is most probable, but they are not always acting textbook. Now, for Bitcoin, in a macro move, in a macro count, like for a daily or higher degree, like a weekly, we will tend to see the fifth wave get a lot of volume. It's not that it got more volume than wave 3, because if you take all the volume during this wave 3, it's still larger than the wave 5. But it's just as the wave 5 went so quickly, in such acceleration, that the volume is occurring in less time, so it shows higher volume on the chart here. But you can see, for example, here we got price divergence. So I'm on a 12-hour chart, can't shift on a 1-day chart maybe. Yeah, so between the top of wave 3 we got a divergence with top of wave 5, which also see a divergence here between this wave 3 and this wave 5, and even between, here we got a 1, 2, 3, 4, and 5, and we got a divergence between the 3 and the 5. Okay. But you see how really wave 3 is a move that shows the most growing interest into the trend. So yeah, we'll talk about the personality of each of the waves. In wave 1, it's rarely obvious at the beginning, unless you well spot the hand of the other trend. But for most of the market, it's not so obvious. You got usually a local change of market structure. Like here we go above, so above that point here, that high, like in local change of market structure. We got increasing volume on the buy side, but the volume is still lesser than what we got during the end of the previous trend. So it's not, that's why it's not so obvious to a lot of people. What we can see is that it uses less volume to go up than to go down here, which means sellers are getting exhausted and buyers are getting more effect for their effort. During that time, usually news is still very bearish, sentiment is bearish, news are negative, and most of the market is looking for the trend to continue down, which is what we saw during this moment. That's when we were at 3K. You could saw on Twitter, for example, because with Bitcoin sentiment is mostly weighted on Twitter until now. And yeah, there was a lot of people putting charts with target to 1K or lower. So wave 2, the sentiment is still bearish and negative. Usually it starts because you got your initial larger interest that stops the trend down here and enter, but slowing down the buying pressure, and the seller are still here trying to keep price down. As price retrace for the wave 2, you see how volume decrease. So this is another way another thing that signal you that interest into this trend is losing interest, losing strength. There is no more downside pressure, if you want. Usually wave 2 is the one that retraces to the golden ratio, the 61.8%. So it retraces 61.8% of when wave 1 impulse. It's a general guideline, but if you introduce, you know already that this is a crucial Fibonacci ratio. And in fact, in a wave 2, it's usually that ratio that is being tagged. It can be lower as long as it doesn't go below the regime of the wave 1, of course. And eventually a low is put in because the initial mover, larger interest that initiates this new trend, are defending the position with resting bids. And the people that are selling here are mostly retail looking for the trend to continue down. Now, wave 3 is the most interesting wave. That's why usually when you start Elliott wave, what you're trying to identify the most is wave 2. That's the most profitable wave to get in, obviously, because it comes after enough confirmation that the trend may have changed, and it comes down low enough to get a clear invalidation, so you can enter a position with a clear invalidation and with potentially very high profitability. Wave 3, this is the wave where the most participants come in. Which I mean, this is where sentiment start to really shift. As long as we go along this wave 3, sentiment will become more and more bullish. For example, if I take the subwave here, so the first subwave 1 usually ends around the top of the higher degree wave 1, and you see wave 3 here is where volume comes in. This is where we got a clear change of market structure, and so this is when the sentiment is starting to shift, and as we go up, we change our market structure and volume is continuing to rise. So this rise is caused by so this rise is caused by the clear market structure change, and as we change the market structure here, for example, interest is growing, people are trying to get in, and the people that are waiting for deeper pullback to get into the trend are likely to be left on the side, which produce even more fear of missing out, and people are rushing into the trade. Bids are getting higher and higher, and we, for example, here we're just making higher high, higher low, higher high, higher low. We never really got a deep pullback. And yeah, candle spread, velocity of price accelerate. It's going parabolic, as you can clearly read here. Okay, so as we go into top of wave 3, again, here wave 5 of this cycle, wave 3, will get higher volume than wave 3, as it is part of the third wave, the strongest one. It's really not uncommon to see greater volume on this move. Now wave 4, that's when that's like the first stress test of the market, where the larger interests that build their position down there are starting to sell big volume, as you can see with this 2 candle volume, even this one. They're starting to get really big traders selling. As this push market in a kind of sideways movement, they're still getting interest into the trend. So you may see big traders and institution still buying the bottom of the range while they sell the tops. Also, the difference we can see between wave 2 and wave 4, more often than not, is that wave 2 go deep, retrace really deep, and wave 4 is more a sideways consolidation. There is just a thing we call the intermittence of the waves, is that if wave 2 were to be really shallow and didn't retrace a lot, then we can expect wave 4 to retrace a lot more. But in a standard, in a classic impulsive move, we will see a deep wave 2 and a shallow wave 4. So as big traders have been able to test resilience of the market, the resting bidding orders, this movement also allows them to psychologically prepare the crowd to deep pullbacks, as there is like local market structure change. If we were to zoom in, it allows the crowd to be ready to buy any deep pullback, like when the move will be done, they will be still buying down there. They will find liquidity to sell into. But as they keep their bid rising, it allows price to continue and finish the fifth wave. So in the fifth wave, usually that's when market exuberance reach its extreme level. You will see almost only bullish news, bullish charts. Bulls will be very loudly. Bears are gonna be mocked, and you will hear about crazy target and that's what we call the extreme FOMO. Something that we experienced also very clearly during 2018 top, where price rise. I can go quickly over this, but we do have our first impulse to something like this, 3, 4, and 5, and price went from 3,000 to 20 in a few months, a few weeks, and then there were people talking about 100k, $1 million Bitcoin during that time. But again, during that move, you see how, especially during a big macro move here, wave 5 can be the largest, even more if you don't look at analog scale. the strongest, the largest, and the most volume. Okay, so the ones that buying in this fifth wave are the late buyers, are the ones that are going to end to be the top buyers. This is led by pure FOMO, people that are feeling that they have been missing on a great opportunity and they don't want to miss it anymore because maybe they heard about Bitcoin before and they were just resting on the sideline, and there is a moment when they just start to kick in, and usually that's the fifth wave. And that will be all for this first lesson. In the next lesson, I will go deeper into how we look for the targets using the FIB extension tools and the retrace as well with the FIB retracement tools. We use also channel and other stuff. Thanks for watching. I hope this was clear enough and helpful. And I see you soon for the next lesson. Goodbye.